Hello, everybody. Tom Ellsworth, the Biz Doc here with another quick stat, and let's go take a look. What did you get? You get to give me a question, and what do you get? The answer. All right. I keep hearing the consumer is in too much debt and is slowing down on spending. Is that true? So why is the stock market doing okay? It was kind of interesting. I had about 9 questions that were woven together like a lasagna of the same thing. There was a little cheese, a little sausage, a little noodle, and it was all the same thing. Wow, I'm hearing, is the economy getting bad? Is it true? So what's stock market? Well, let's go take a look at this. Let's go take a look, because there is some things out there as we're sitting here at the end of July 2024, tell you a little bit of what's going on. First of all, yes, after COVID recovery, things are tightening up. Remember, COVID recovery was 2023. 2022, interest rates went crazy. And 2023, Magnificent Seven, all these crazy things on the stock market. So let's go take a look. Number one, this is what you may have been seeing, and this is why you're asking a question. So that's a good question. Consumer credit delinquencies are the worst since 2012. So that's 12 years ago. Let's go take a look. The black line is 30 days past due. The pink line, 60 days past due. And by the way, yes, they're telling me it's Miami pink. Once you move down to South Florida, everybody's very, very Miami-ish. Anyway, the pink is 60 days past due, and the gold is 90 days past due. So you take a look. These things were staying kind of stable, and they dropped real bad in 21. Now, why did delinquencies go down? Because you got free money from the government, you paid off a little bit of your credit card, and you weren't buying stuff in terms of travel and vacations and going out to eat because you were at home under the lockdown mandate, wearing your mask. Well, afterwards, we all got to go out to play, and look what happened, 22 to 23, woohoo! But, now take a look at it. The delinquency rates on credit cards are going up, and Americans have now $1.2 trillion in credit card debt. All-time high. Is this good? No, this is not good. It's a sign that maybe, there have been little peaks and ups and downs in here, but there's a sign that maybe something's going on with the consumer right now. Maybe that's not good. And auto repossessions are up 23% 2024 first quarter versus 2023. Well, if you're delinquent on one type of debt, is it any shock that you're delinquent on your car payment? Nope. So what's going on? Well, here it is. Total consumer debt is the highest in 20 years. Remember, I've been looking at some 10-year charts. I've been looking at, take a look at this. 20 years, 2004, 20 years, 2024. Now, the housing debt went up because gently the price of houses go up. But you notice it's not a big spike, but it's a run-up right here. But then there's the credit card debt. It usually happens in this order. You can see a very clear run-up right there going on with the house, and then the credit card goes right there with it. And the 2 bumps, there you go. So there's the non-housing debt. So take a look at this. Remember, 2008 was the financial crisis. We were here. Now we're here. Look at this. This is huge. So now the consumer has got a lot of debt, and we have a lot of delinquencies. That means they're going to be buying less stuff. So what does that mean? It's starting to show up in earnings for company. Well, of course it is, because people are buying less stuff. 30% of the S&P 500 have reported their Q2 results as of today. Only 43% of them have beat revenue expectations. Means 57% have not beat revenue expectations, less revenue than they said they were going to have. And this is the lowest level in 5 years going back to pre-COVID. Chart time. So when this goes up, it's good. It means a lot of companies are announcing earnings. Hey, we announced that we have $1 billion of earnings here at The Gap for Q1. I'm happy to say we have almost $1.1 billion in earnings. Guess what? That's the news they want. When that happens, this happens. So you can see, what was being driven, and now only 42.9%, 43% right there, of companies are announcing earnings that are above what they guided. This is not good. This means that now the stock market is seeing the effect of the consumer debt, the consumer spending, and the delinquencies. As they say, Did you see how much hay and leaves that elephant just ate? Oh my goodness. What do you think of that? They say, I don't know, but I don't want to be here when he takes the dump. Well, guess what? That's kind of what it is. You look at the consumer spending and the consumer debt. Guess what? Spending is about to take a dump, and dump it will be. So now, what else do we see? What are the CEOs and the directors and the executives that get stock options? What are they doing about this? Because they're running those companies on that chart I just showed you. Corporate leaders are not buying as much stock. Uh-oh. It's the lowest level since 2014, since 10 years ago. Uh-oh. Here it is. Insiders have taken a bearish turn. Bear is bad. Bull, I'm running like a bull. Off to the races. Bear, I'm an angry, growly bear. That's bad. So bear markets are bad. So what percent of publicly traded corporations are completing net buying down? Here's net buying. It is normal for a CEO to be selling stock. Bill Gates and any other person you'd be around, Jeff Bezos, they have stock plans where they sell it on a regular basis and they do other things. Bill Gates wants to put in a Gates Foundation. Jeff Bezos wants to buy expensive things like rocket companies and newspapers and do all those things. So they have natural, what's called a programmed or a pre-scheduled trading. That's trades where they sell, and that's predictable. There's always people that want to buy, and the CEO that says, hey, I'm taking $1 million in my own IRA and I'm buying my own stock because I believe in me, I believe in this company, I believe in my people, and I believe in the customer and our product. Woo! Go us. Guess what? The market likes that. Well, net buying is the difference between when they're buying and all that stuff they're selling, even if they're selling on a schedule. Make sense? Buys minus schedule sales, it does whoop, 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 whoop. Except the 10-year average was it would be 30% more buying than selling. Look at this, down there. And that is the lowest level since 2014, 10 years ago. So not only are we seeing no earnings surprises, we're seeing CEOs and people not buying stock. They're letting it go down, and they are selling on the way down. Never a good sign. So that's what's going on. You asked about the question between those interrelationships, that's what's going on. So maybe it's time to be conservative. Look out for yourself. Don't wait for the market to figure it out for you. You take a chunk out of it and you go do what's right for you, living conservatively, being proactively about new skills, side hustles, and whatever you have to do to get through it. Until next time, I'm Tom Ellsworth, the Biz Doc, and we'll have another quick take.